So in our last class, we started adjusted present value, and I mentioned to you that APV is a technique designed principally to evaluate a project when business and financial risk, or when financial risk or debt equity proportion are expected to change as a result of a company undertaking a project. Okay, so APV is used when issue costs or subsidized loan are provided in the question, because APV and NPV are almost the same thing in the structure, in the way the examiner will structure the question. But if in the question you can see anything like issue cost or subsidized loan, then you should know that you are supposed to apply the adjusted present value technique to evaluate the project. And I mentioned that APV is a technique that separates the cash flow from operation from the cash flow arising from financing and appraise each of them independently. Therefore, whenever you want to compute APV, there are four procedures that you are supposed to carry out. The first step is to calculate the base case NPV, which represents the cash flow arising from the operation. Then step two, we calculate present value of financing effect cash flow. Then step three, you calculate adjusted present value. Step four, you advise on the acceptability of the project. And I said that whenever you want to compute the base case NPV, there are technically three procedures that you are expected to carry out, or four procedures that you are going to undertake. The first step is to determine the relevant cash flows, the net cash flow arising from the project, from the operation. Then step two, you calculate the cost of equity loan geared, and then this cost of equity loan geared can be calculated in three different ways, depending on the information of the proxy company given to you. So if you are given the information, if you are given the beta of a proxy, then there are three steps that you're supposed to carry out. The first step is to identify the beta. Then step two, you ungear the beta if it is geared. Then step three, you calculate cost of equity ungeared using capital asset pricing model. Then the other part, if you are given cost of equity of a proxy, then in that case, you are supposed to use the Miller and Modigliani formula of calculating cost of equity. Then the third one, if you are given beta, if you are given a work of a proxy, then you are supposed to calculate work of ungear. So work of ungear is the same thing as cost of equity ungear. So of course, I demonstrated for you how you are going to calculate each of them whenever you see it in a question. Then we now proceed to discussing how to calculate the PV of financing effects. I said that when you want to calculate PV of financing effect, the first thing you need to do is to determine, or you decide whether you want to use cost of borrowing or risk-free rate of return as your discounting rate for the PV arising from financing effects. Then the step two that you are going to carry out, you also need to decide whether you want to use the gross finance required or the net finance required for the cash flow arising from subsidized loan, as well as the tax saved on interest. Okay, tax saved on interest. All right. Then step three, you calculate the PV of issue cost. And I said that the PV of issue cost will be computed. You have about four procedures also that you are going to carry out. But before then, I'll explain what issue cost is all about. I said issue costs are costs associated with underwriting and raising debt and equity capital. I mentioned the examples of issue costs to include the marketing expenses, okay, registration fee paid to Security and Exchange Commission, the investment banking fee, which will be paid to the intermediary that will stand between the public and the company that is raising the fund. Then you are also going to pay professional fee, including the legal fee as well as the audit fee. These are some of the examples of issue cost. So whenever you want to calculate the issue cost, there are four procedures. The first procedure is to determine the issue cost amount. And I said that the issue cost amount represents the gross finance required multiplied by the issue cost rates. You are going to multiply the issue cost rate, the percentage of the issue cost. You multiply on the gross finance required. That will give you the gross. That will give you the issue cost amount. So step 2 is to calculate the PV of issue cost in year 0. The PV of issue cost in year 0 will be in two folds, depending on whether you are given debt and equity. So where you have debt and equity, you are going to calculate it separately. So to get the PV of issue cost in year 0, you are going to multiply the gross finance required on debt. You multiply with the issue cost rate on debt. Then you are also going to multiply the gross finance rate. You are going to multiply the issue cost rates on equity with the gross finance required on equity. So that will give you the PV. Of course, you multiply with discount factor at year 0, which is always 1. So which means that whatever you have as your issue cost amount for equity and debt is the same thing you are going to have as the present value of issue cost in year 0. Then step 4 or step 3 technically is to determine the present value of issue cost amount on debt. Tax saved on the present value of issue cost amount in year 1 only, because it is believed that there will be tax benefits, that will be tax relieved on issue cost on debt. Okay, so once that is done, you add everything together, then that will give you the present value of issue cost. Okay, then you then go back to the question and identify if you are given subsidized loan. So if you are given subsidized loan, I said that there are 4 procedures. The first procedure is to determine the amount attributable to subsidy. And that is, you calculate subsidy amount. Subsidy amount is calculated as the gross finance required multiplied by the proportion of subsidized loan. So that will give you the subsidy amount. Then step 2, you calculate savings on subsidy. Savings on subsidy represent the difference between the normal borrowing rates and then the interest rate on the subsidized loan. Then step 3, you calculate net subsidy. To get the net subsidy, you multiply the subsidy amounts with the savings of subsidy and then 1 minus tax rates. So that will give you the net subsidy. Then the last step, which is step 4, is to calculate the PV of a subsidized loan, of net subsidy, rather, PV of net subsidy, which is computed as net subsidy multiplied by the annuity factor. So those are the 4 procedures that you are going to carry out whenever you want to compute present value of net subsidy. Then the third one, or the 5th or 6th procedure that are going to carry out is to calculate the PV of tax saved on interest. PV of tax saved on interest. So when you want to calculate the PV of tax saved on interest, I told you there are 3 procedures. The first procedure is to determine the amount attributable to, or you accumulate all interest elements. You accumulate all interest elements. What is the interest expense on subsidized loan? What's the interest expense paid on the normal borrowing? To get the interest expense on subsidized loan, you are going to multiply the interest rate, the interest rate on the subsidy. You multiply on the subsidy amount. That will give you the interest expense on the subsidized loan. Then the interest expense on normal borrowing. So how do you determine that? Simply multiply the interest rates, the normal borrowing rates. You multiply the normal borrowing rates on the amount attributable to normal borrowing. The amount attributable to normal borrowing is the gross finance required multiplied by the proportion of normal borrowing. So you now add up all the interest expense together to get the total interest. You then move to step 2. Step 2 is to calculate the tax saved on interest. The tax saved on interest is the total interest multiplied by the company tax rates. Then step 3 is to calculate the PV of tax saved on interest. The PV of tax saved on interest is the tax saved multiplied by annuity factor. So that's what you need to do whenever you want to calculate the PV of tax saved on interest. Then you now go to step 3 of calculating the APV, which is to calculate APV itself. So to now get the APV, Of course, you are going to consider APV is base case NPV plus minus the PV of financing effective cash flow. So, of course, at the end of the day, once you have your APV, it could be positive or negative. And I told you it's the same decision rule that you have for NPV that you have for APV. All right. If it is positive APV, we advise that the project should be undertaken or should be accepted. But if it is negative NPV, the project should not be undertaken. So, and this is what we did in our last class. So now we want to have illustration. We can't have more than one illustration because question on APV is usually very big and then as well as is technical and it takes time. All right. So the good thing is that we'll have several examples that you can try at your hand. So question and answers, you can try to have more insights into the adjusted present value. So without wasting more time, let's have illustration. This is the last question tested by ICAN on adjusted present value. And the last time ICAN tested it was in 2019. Ever since then, we'll be expecting the examiner to try it again, but they are not forthcoming. So you never can tell. Maybe they come out to you this in your May diet exam. We don't know. But in any case, let's quickly solve the question. So yeah, so like I said earlier on when I started, I have issue. My pen is not connecting. So I don't know. I can't write, I can't annotate on the screen. Please let's manage together while I find solution to this in our next class. Okay. Yes. Who will read for us, please? Somebody should help us read. Who will help us?
I'll read.
Thank you.
Alcantara Limited, AL, is an unlisted company based in Akure, Nigeria. Over the years, the company has been producing and selling agricultural support tools. AL is now considering the production and sale of yam powders. Although this is a completely new venture for AL, it will be in addition to the company's core business. AL's directors plan to develop the project for a period of 4 years and then sell it for 24 million to a group of young investors. The government is excited about the project and has offered AL a subsidized loan of up to 80% of the investment funds needed at the beginning of the project at a rate of 200 basis points below AL's borrowing rate. Currently, AL can borrow at 300 basis points above the 5-year government debt yield rate. A feasibility study commissioned by the directors at a cost of 5 million naira has produced the following information. The company can buy an existing suitable factory at a cost of 16.5 million naira payable now. 4.5 million naira is required now to buy and install the necessary plant and machinery. The company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. The unit selling price for the first year will be 3,750, but this will increase by 3% per year thereafter. In the first year, the total variable cost per unit will be 1,800 naira, but this will increase by 8% per year thereafter. In the first year, the fixed overhead cost will be 3.75, of which 60% are centrally allocated overheads. The fixed overheads will increase by 5% per year after the first year. AL will require working capital of 15% of the anticipated sales revenue for the year at the beginning of each year. The working capital is expected to be released at the end of the fourth year when the project is sold. AL's tax rate is 25% per year on the taxable profit. Tax is payable in the same year as when the profits are earned. Tax allowable depreciation is available on the plant and machinery on a straight-line basis. It is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 naira of the price at which the project is sold. No tax allowable depreciation is available on the factory. AL uses 12% as its discount rate for new projects, but feels that this rate may not be appropriate for this new type of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government's offer of a subsidized loan. Issue costs are 4% of the gross finance required. It can be assumed that the debt capacity available to the company is equivalent to the actual amount of debt finance to be raised for the project. Although no other companies produce yam powders in the country, Cascare Limited (CL) produces cassava crushing machines using almost similar technology to that required for yam powder. CL's cost of equity is estimated to be 14% and it pays tax at 28%. CL has 15 million shares in issue, trading at 2 naira 53 kobo each, and 40 million naira bonds, trading at 94 naira 88 kobo per 100 naira. The 5-year government debt yield is currently estimated at 4.5% and the market risk premium at 4%. Required: A. Evaluate on financial grounds whether AL should proceed with the project. 28 marks. B. Discuss the appropriateness of the evaluation method used and explain the assumptions made in Part A. C. Provide examples of ethical issues that might affect capital investment decisions and discuss the importance of such issues for strategic financial management. 7 marks.
Thank you very much. Yes, that is the question. You can see is a very big one. From the requirements, number A, you have to evaluate on financial grants whether AL should proceed with the project. So you can see in these requirements, you are not told which method to use to evaluate the project. So there's no difference between the structure of this question when you want to use NPV, all right? Whether you want to use NPV or APV, you can see it's the same structure, all right? So, but however, when she was reading the question, you heard her say in the second paragraph where the examiner mentioned, where she mentioned the subsidized loan. So you are given you are told that the government is excited about the project and has offered AL a subsidized loan of up to 80% of the investment funds needed at the beginning of the project. Okay, at the interest rate of 200 basis points below AS borrowing rate. So because you are given subsidized loan, so you need nobody to tell you that this is adjusted present value. This is purely adjusted present value because NPV, the net present value, does not consider itself with issue cost or subsidized loan. So I told you when I was explaining the concept, once you see issue cost or subsidized loan or subsidy in the question, you need nobody to tell you that you are supposed to apply the adjusted present value to evaluate the project. So if that is the case, let's solve the question then. So you want to calculate adjusted present value. I told you there are 4 procedures. The first step is to calculate the base case NPV. Step 2, you calculate the PV of financing effect cash flow. Step 3, you calculate APV. Then step 4, you advise. We advise. Those are the 4 procedures. So let's solve the question. So we want to calculate base case NPV. How do we calculate base case NPV? Very simple. Just calculate normally the way you normally calculate your net present value. That's the same way you are going to calculate the base case NPV. The only difference is just the fact that you are going to use the cost of equity on geared to discount your net cash flow. Instead of using the company WACC, you are expected to use the cost of equity on geared to discount the cash flow. That's all. That's just the difference between the normal NPV and the base case NPV. So, and you know that whenever you want to calculate NPV, what do? You go to the question, you identify relevant cash flow, or you determine the relevant cash flow. You go to are you given selling price? If you are given selling price, is there any inflation? You inflate the selling price. Then you multiply with number of units sold. You get your sales value. You post. You go back to the question. Are you given variable cost? Yes, there is variable cost. Is there any inflation on variable cost? Yes, there is inflation. You inflate the variable cost per unit. You multiply with number of units produced. Then you get your total variable cost. You go and less from the sales. Then you go back to the question again. Am I given specific attributable or direct fixed cost? If you have it, is there any inflation? You inflate your fixed cost, then you post. You go back to the, of course, if there's any other relevant cash flow in the question, you calculate appropriately. Then you determine your profits. After your profits, you apply tax rates. How do you pay your tax? In the current year or in arrears, whatever the case may be, apply your tax. Then you calculate the tax saved on capital allowance. Then you determine your scrap value or disposal value, if any. You determine your initial outlay. You determine your working capital. Then you have your net cash flow. So once you have your net cash flow, then you now go ahead and do workings for cost of equity on gear, depending on the information of proxy given to you. So once you get your cost of equity on gear, then you discount the net cash flow, you have your base case NPV. It's as simple and straightforward as that. All right, so quickly, let's walk through that. So we want to calculate base case NPV. So like I said, we are going to use a worked example. So the first thing we are going to do is to calculate, you go back to the question. Let's go back to the question and identify the information. We need selling price. We need variable cost. We need incremental fixed cost. So let's go back to the scenario. We are coming back to the second paragraph. That one has nothing to do with the sales value variable cost that we want to calculate for now. All right. Then you are now told in the third paragraph that the feasibility study commissioned by the directors at a cost of 5 million naira has produced the following information. So there's a feasibility study of 5 million naira. That 5 million naira, is it relevant or irrelevant? Let me hear from you.
Irrelevant.
Why is it not relevant?
Because it has been incurred already.
It's a sunk cost. It's not relevant because it's a sunk cost, past cost. So you're now told that the company can buy an existing suitable factory at a cost of 16.5 million naira payable now. That 16.5 million naira represents the initial outlay. This is a second-hand asset, which means that the second-hand asset is not qualified for capital allowance. So you cannot claim capital allowance on the second-hand asset as far as finance is concerned. So it is believed that the original owner of this building might have been claiming the capital allowance and they cannot transfer it as far as finance is concerned. So that 16.5 million naira is the initial outlay, and then it's not qualified for capital allowance because it's a second-hand asset. So then bullet point 2, 4.5 million naira is required to buy and install the necessary plants and machinery. Okay, that's another initial outlay to buy plants and machinery. So, of course, since you are just buying these assets newly, the plant and machinery, you are just buying it newly at 4.5 million. So that 4.5 million naira qualify for capital allowance. So you are going to compute capital allowance on that. However, the total initial outlay would then be equal to 16.5 million plus 4.5 million. That will give us total outlay. Then, in bullet point number 3, you are told that the company will produce and sell 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. So in this case, what are you supposed to do? You are told that 1,300 units will be produced and sold for the first year. And you are told that there's inflation. There's a growth rate on the number of units produced and sold by 40% for the next 2 years, then falling to 5%. What are you supposed to do in this case? The most important thing you need to do, just multiply in the first year sales units. We are not going to inflate that because that's your base year unit. Then to get the units for the second year, you are going to multiply 1.4 by this 1,300. You multiply 1.4 by 1,300. So that means you have inflated the units for the second year. Then to get for the third year, you are going to multiply the second year sales unit with 1.4. All right. Then for the third year, of course, whatever you have in the third year, when you get to the fourth year, you now multiply with 1.05 because it's no more growing at 40%. Rather, it will grow at 5%. Okay. So quickly, let's go to our working and see how that is done. Working. Okay. Let's see. Yeah. So this is the working for the sales units. In the first year, the sales units given to us is 1,300. And you are now told that it will grow by 40% for the next 2 years. So you don't grow the first year units. Rather, inflation should start from year 2. All right. So the first year unit is 1,300. Therefore, 1,300 multiplied by 1.4 will give us 1,820. 1,820 multiplied by 1.4 for the third year will give us 2,548. Then we're now told that in the fourth year, it will fall to 5%. Therefore, 2,548 multiplied by 1.08, that will give us 2,675. Let me use calculator. So like I said, in the fourth year, so you have the third year, you want to grow the number of units in the third year, which is 2,548 multiplied by 1.05. So that's what produced 2,675. So that's the number of units in the fourth year. So that's another way of doing it. Or you may want to do it the way I've done it, the way you are seeing it on the screen. All right, just repeat the unit for each year. Then, of course, then say 1.4 raised to power 1 multiplied by 1,300. That will give you 1,820. For year 3, 1.4 raised to power 2 multiplied by 1,300 will give you 2,548. Then in year 4, it's no more growing at 40%. It has reduced to 5%. Therefore, you are going to grow the year 3. You are going to grow the year 3 compounding factor. You multiply with the 5% that it has fallen to. So that's what produced the 2. Then you now multiply with 1,300. That's what produced the 2,675. That's a long thing to do. I did it just to simplify it further. Ordinarily, what you're supposed to do is that, of course, you know that the unit sold in the first year is 1,300. Just to get the unit sold and produced in the second year, just multiply 1.4 by 1,300. It will give you 1,820. 1,820 multiplied by 1.4 will give you 2,548. 2,548 in the fourth year, it has reduced to 5%. Therefore, 2,548 multiplied by 1.05, that will give you 2,675. So now that we have the units sold, then the next thing we need to do is to calculate the sales revenue. We need to calculate sales value. To get the sales value, what are you supposed to do? I will then go back to the question. The selling price per unit, according to the question, is 3750. That's the bullet point number 4. Okay. The selling price, the unit selling price for the first year will be 3750, and we increase by 3% per year thereafter. So selling price is 3750. You are given the first year price. Since you are given first year price, then inflation should start from year 2, meaning that you should start inflating from year 2, because you don't inflate the first year price. Okay, so if that is the case, and you are told that inflation rate is 3%, therefore, first year selling price is 3750. Then you now multiply with 1.03. Okay, so let me show you. Now, the first year selling price is 3750. To get the second year selling price, this one, the method I use on this, that you have seen in this format, on the screen, the method I use there is just to simplify it to, is this just a primary school thing. So you shouldn't be doing this on the day of your exam. It's a waste of time, because you already know that your selling price will grow by 5%. Sorry, will grow by 3%. So to save time, the first year price is 3750. So to get the second year price, just multiply the 3750 multiplied by 1.03. That will give you 3863. That's the 3863 you are seeing here. Whatever you have in your calculator, then you multiply with 1.03, which is 3978. That's the 3978 you are seeing in the third year. What you have in your calculator, multiply with 1.03. That's what produce 4098. That's the 4098 you are seeing there. So that's what you should do. Don't go and be doing this method. This will slow down your work. Then, now that you have the inflated selling price, the next thing you need to do is to multiply with the number of units sold. Here is the number of units sold. Let's say that is A. Then you multiply 1300 in the first year by 1300 by 3750. So that's what produced 4875. Then in the second year, 1820 multiplied by 3863. That's what produced 7031. Then in the third year, number of units is 2548. You multiply with the inflated selling price of 3978. Then we have 10,138. Then in the fourth year, number of units sold is 2675. You multiply with the selling price of 4098. That's what produced the 10960. Then, now that you have calculated the selling price, sorry, the sales value, the next thing you need to do is to go and post. I will then go up there, go and post. So these are the sales revenue in the first year. From year 1 to year 4, that's the sales value. Then let's go and calculate the variable cost. So to get the variable cost, you go back to the question again. You are told that in the first year, the total variable cost per unit will be 1800, but this will increase by 8% per year thereafter. So variable cost is 1800, inflation rate is 8%. So let's go and calculate that. Okay. So again, in the first year, variable cost is 1800. To get the variable cost for the second year, since inflation rate is 8%, therefore I will say 1800 multiplied by 1.08. 1800 multiplied by 1.08. So that's 3240. That's 3240. Sorry, I made a mistake, not 1.8. 1800 multiplied by 1.08. What's wrong with it? 1.08. Yes, that's 1944 for the second year. So 1944 multiplied by 1.08. That's 20. That's 2100. Because here I have 2099.52. That's 2100. That's the 2100 you are seeing in the third year. Then for the fourth year, what you have in your calculator multiplied by 1.08. That's 2267. That's 2.267 that you have there. Sorry, not 2 points. That's 2267. So the next thing we need to do is to get the total variable cost. So to get the total variable cost, you multiply the very inflated variable cost per unit with the number of units produced. All right. Therefore, number of units produced in the first year is 1300. Therefore, 1300 multiplied by 1800 in the first year. That's what produced 2340. Our figures are in thousands. Then the second year, the inflated variable cost is 1944. Number of units in the second year is 1820. Okay. Then when you multiply that, we have 3538. In the third year, the inflated variable cost is 2100, is 2100. So 2100 multiplied by the unit produced. Okay, units produced in the second year, in the third year of 2548. That's what produced the 5351. You do the same thing for the fourth year. The inflated variable cost is 2267 multiplied by the unit of 2675. We have 6064. Again, you go and post. Once you are done with your working, then you go and post. Okay, so that's what you have here. Of course, you are lessening it from the sales value. All right. Then we go back to the question again. In case we have incremental, specific, or attributable fixed cost. So let's go and check. After variable cost, the next bullet point, we are told that in the first year, the fixed overhead cost will be 3,750,000, of which 60% are centrally allocated overhead. The fixed overhead will increase by 5% per year after the first year. So examiner has told us that the fixed overhead is 3,750,000. So since our figures are in thousands, so this will be 3,750. Now, you are told that out of this 3,750, 60% is centrally allocated. Centrally allocated means overhead, means head office charges. That's head office charges. It's an allocation. So it's not a relevant cost. That 60% is not relevant. So that means only the 40% of it is relevant. Therefore, you then multiply 40% of 3,750. So that's what you are going to have there. Let's go and do the workings for fixed overhead. Okay, so here is the 40% of the 3,750, which is 1,500. So the inflation rate on fixed overhead is 5%. Therefore, 1,500 multiplied by 1.05. That's what produced 1575. 1575 multiplied by 1.05 will give us 1654. 1654 multiplied by 1.05. That's what gives us 1736. Then you go and post. Okay, so that's it here. That's the numbers there. Then at this point, I'll go back to the question again in case I have other relevant cash flow. After the fixed cost, the next item is working capital, which we are going to treat later on. The next one is tax rates, information on tax rates. Then we're also given information on the on discount rates on subsidized loan. So that means we don't have any other cash flow again. Apart from that, of course, we have said that the feasibility study at the cost of 5 million naira is irrelevant. So if that is the case, let's determine profits. All right. So of course, the sales value minus variable cost minus the fixed cost will give us profit of 1035. Do the same thing for the second year. 7031 minus 3538 minus 1575 will give us 1918. The third year, 10,136 minus 5351 minus 1654 will give us 3131. Then for the last year, the final year, 10,962 minus 6064 minus 1736 will give us 3162. So that represents the taxable profits. So with this, the next thing we are going to do is to pay tax. We then go back to the question, go and identify the company tax rates. So you are told here that a health tax rate is 25% per year on taxable profit. Tax is payable. Tax is payable the same year as when the profits are earned. So if that is the case, then let's go and determine our tax liability. Tax rate is 25% and is payable in the same year that the profit is earned. Therefore, 25% of the first year profit of 1035, that's what gave us the 259. In the second year, 1918 multiplied by 25% will give us 480. In the third year, 3131 multiplied by 0.25 will give us 783. In the fourth year, 3162 multiplied by 0.25 will give us 791. With this, we have calculated the tax liability. The next thing we need to do is to calculate tax saved on capital allowance. How do I get tax saved on capital allowance? I will go back to the question. How do I calculate my capital allowance? The information will surely be given to you, if any. So still on that same paragraph where you have the tax liability, you are told that tax allowable depreciation is available on plant and machinery on a straight line basis. Tax allowable depreciation is the same thing as capital allowance and is available on plant and machinery on a straight line basis. It is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 naira of the price at which the project is sold. No tax allowable depreciation is available on the factory. Like I explained to you when we started the question, I told you that the existing factory that costs 60 million naira does not qualify for capital allowance. It's because it's a second-hand asset. All right. So only the plant and machinery at 4.5 million naira will qualify for capital allowance, and that is what the examiner is telling you here, that no tax allowable depreciation is available on the factory. Okay, so if that is the case, and the examiner has told us that the tax allowable depreciation is available on the plant and machinery on a straight line basis, so I don't need to waste time. All right, I don't need to waste time on this. Since the plant and machinery is 4,500, the cost of the plant and machinery is 4,500. All I need to do is examiner has told me that it's on a straight line basis. So if that is the case, I will just say cost minus scrap value divided by the useful life of the assets. The cost is 4,500. The scrap value of this plant and machinery is 600,000 naira. Is 600,000 naira of the price at which the project is sold. The price at which the project is sold is 24 million naira, according to the question. Because examiner told you that you are told that AS director plans to develop the project for a period of 4 years and then sell it for 24 million naira to a group of young investors. So this 24 million naira is the scrap value of the project, that's disposal value of the project after 4 years. So out of this 24 million, 600,000 is the disposal value of the plant and machinery. So that 600,000 scrap value of the plant and machinery is embedded in this 24 million naira. Okay, so that's what the examiner is telling you here, that you are told here that it is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 naira of the price at which the project is sold. The project is sold for 24 million naira. So out of that, 600,000 is made for plant and machinery. So like I said, to calculate my tax saved on capital allowance, let's go and do the workings. I've already explained what you need to do, but let's check the workings. Okay. Now, I don't need to be doing this on the day of your exam. This is a primary school method of calculating tax saved on capital allowance. All right. Since examiner has told us that it's on a straight line basis, what are you supposed to do? First thing first, you calculate capital allowance. You calculate annual capital allowance. Your annual capital allowance is the cost of the asset minus scrap value divided by the useful life of the asset. Okay? Divided by the useful life of the asset. So the cost of this plant and machinery is 4,500. The scrap value is 600,000. So let's do it together. So 4,500 minus 600, that will give us 3,900. So 3,900 divided by the useful life of 4 years, that's 975. That's 975,000 naira. So annual capital allowance is 975,000 naira. So to now get the tax saved on capital allowance, so you multiply the capital, to get the tax saved on capital allowance, then you multiply the capital allowance of each year with the company tax rates. Okay, capital allowance multiplied by company tax rate will give you the tax saved. Therefore, 975, okay, 975 multiplied by tax rate is 25%. So multiply by 0.25. We have 243.75. You round your number to 244. So you round your number to 244. That's how we got the 244 for each year. Then in the final year, you cannot put 244 because once you put 244, it will be more than the capital allowance claimable. The total capital allowance is 975. So if you put 244 for the fourth year, you are going to exceed the capital allowance by 1. Therefore, you restrict the last one to 243. So that's what I've done there. Again, on the day of your exam, you may not follow this. If this is the best way you can do it, that is more convenient for you, please do it. Do it. But again, we have a faster method of solving this. That's what I'm just trying to communicate. So let's just go and indicate the capital allowance. That's saved on capital allowance. Okay. Now this is it. That's saved on capital allowance for each year. Then the next thing we are going to do is to indicate the scrap value. You know, you have a format, all right? So you indicate the scrap value. We are told that the project will be sold to young investors at 24 million naira. That is 24 million naira in year 4. Okay, that's 24 million naira there. Then we indicate the initial outlay. The initial outlay are in 2 folds. One for existing building, one for plant and machinery. All right. Initial outlay is 16.5 million plus the 4.5 million. So that's what produced the 21 million naira. So that's the 21,000 you are seeing there. Our figures are in thousands. Then the next thing is working capital. So let's go back to working capital. Where do you have information on working capital? Yeah, I saw it somewhere. Working capital, working capital. Okay, yes, this is it. We are told that here we require working capital of 15% of the anticipated sales revenue for the year. So working capital is 15% of sales value at the beginning of each year. The working capital is expected to be released at the end of the 4th year when the project is sold. Therefore, since working capital is 15% on the sales value, so let's go and calculate that.